Okay, today we are talking about the three tools of monetary policy. First, we have the discount rate. This is the interest rate that the Fed charges commercial banks when they borrow money. So sometimes Bank of America will have to borrow money from the Fed so that they have enough to cover their required reserves. And when they do that, they pay the discount rate, which is an interest rate. Reserve requirements I've already taught you about. This is the percent of deposits that banks must hold in their reserves, aka the percent that they can't loan out. This is set by the Federal Reserve. Finally, there are open market operations. It's the most important one. It's used most often. And this is when the Fed either buys or sells government securities, aka bonds. In order to increase the money supply, the Federal Reserve would buy bonds. So buy bonds, big money, increases the money supply, makes it easier for us to get our hands on money. It makes the interest rate lower, cheaper to borrow money. If they want to decrease the money supply, they would sell bonds small money, and that would make it harder to get money. Okay, so the discount rate. Again, the interest rate that the Fed charges other banks for borrowing money. To increase the money supply, the Fed should decrease the discount rate. That makes it cheaper for commercial banks to borrow from the Fed, which in turn would make it cheaper for us to borrow from them. That's an easy money policy. The goal there is to increase aggregate demand. To decrease the money supply, the Fed should increase the discount rate. That makes it more expensive for banks to borrow from the Fed. Then the banks will charge us more. That's a tight money policy. It makes it harder for us to get our hands on money, which will cause us to spend less. All right. Open market operations is when the Fed buys or sells government bonds. Again, to increase the money supply, the Fed should buy bonds, big money. To decrease the money supply, the Fed should sell government bonds, sell bonds, small money. Okay, there is also what's called the federal funds rate. This is the interest rate that banks charge one another for one-day loans of reserves. If Bank of America has to borrow from Wells Fargo so that they can cover their required reserves today, they pay what's called the federal funds rate. The Fed does not set this rate. They just try to influence it, mainly by buying and selling bonds to try to influence the nominal interest rate. All right, here we go. If we are in a recessionary gap, so our short run equilibrium is to the left of the long run aggregate supply curve, our goal here is to increase aggregate demand. You need to get people to start spending money again. To do this, the Fed has three tools. They can lower the reserve requirement ratio. If they tell banks they don't have to hold on to as much money, they'll loan more out. We'll get our hands on money more easily. We'll spend it. Aggregate demand shifts to the right. They could also lower the discount rate. If commercial banks pay less to borrow from the Fed, they'll charge us less, and we'll get our hands on money more easily. Aggregate demand will shift to the right. Or if they buy bonds, big money, if they buy bonds, there's more money in the economy. It's easier to get your hands on it, so we'll spend more of it. Aggregate demand shifts to the right. The opposite of that, if we're in an inflationary gap, your goal then is to decrease aggregate demand. You need to get people to stop spending money, so you take it away. You can increase the reserve requirement ratio, which would mean that banks can't loan out as much. If they can't loan out as much, we don't get our hands on money as easily. Aggregate demand shifts to the left. They could increase the discount rate. Again, banks don't get as much. It's harder for a commercial bank to get money from the Fed. They'll charge us more for it. We'll spend less. Aggregate demand shifts to the left. And then finally, sell bonds, small money. If the Fed sells bonds, there's less money in the market in general. We won't be able to get our hands on it as easily. We'll spend less. Aggregate demand shifts to the left. All right, look at the next video, and I will show you a couple examples from your work for today.